one of the most read stories on the Bloomberg terminal, looking in 3 to 4 simple charts, John. Congratulations on this terrific note where you look at market correlations for warnings. Now, the first one that caught my attention, which actually the story we led with is watch credit spreads versus equities. So what do they tell us now?
Right now, they're telling us that there's a lot of cyclical optimism, which is why spreads have been tightening and equity prices have been going up. I think the decorrelation one needs to watch for over the course of the year is the possibility that spreads move wider in some parts of credit and that the equity market still might press higher. Some people would look at that divergence and say it's a warning signal. I say that it depends on what's causing it. If it's a profit slowdown, then you certainly want to see the credit markets as a lead indicator for bad things to come in equities. But if it's supply-driven, if it's been driven by more M&A activity, as I think it would be in the second half of the year, then this is not something to worry about. So the cause matters. It's not just the correlation.
And John, I'm going to try and get them up in a second, but actually talk to us about some of the other divergences. I know you had, for example, EM versus DM currencies.
I think that one's interesting because it's so rare that DM currencies would be going down versus the dollar as they have been this year, while EM currencies as a basket will be going up versus the dollar. Usually these move together versus the US dollar, and it's usually around some common set of circumstances outside the US. So the fact that we're seeing DM currency weakness versus the US dollar tells you there's some weak non-US economies in the G10. This is mainly Europe and also the Antipodeans, and that's why I can live with this kind of divergence. I think there's something very peculiar going on in Europe and also something very odd going on in Australia and New Zealand. Those central banks have much lower policy rates than you usually see versus the US. And I think for that reason, you could still have the dollar going up versus some DM pairs, but it eases off versus the high yielders in EM.
John, I want to go to a chart, and it's good to see that you're on the same page with a guy named Diamond. That always helps the resume as well. This is China GDP, and buried in John Normand's JPMorgan view, which is a really important, dense read, is the idea of an upgrade in China, and for that matter in the U.S. as well. The zeitgeist right now is here. Here's a hard landing on Chinese GDP growth, and JPMorgan says no, and you've got a real sustaining GDP above 6%. John, is that going to be the great call of this year?
I wouldn't call it the great call because all we're looking for is a minor upgrade in growth from 6.2
but I'll take
now to maybe 6.5, and I think that's better than you're going to get in a lot of other countries, and I think that's why it's important when you're looking at country allocation and why you would want to have exposure in EM assets, whether that's stocks or currencies and fixed income versus EM assets. I don't think this is going to be the trade of the year. This has already happened in terms of a lot of the reweighting back into EM assets. So even if you get China growth improving, I don't think it's probably worth more than another 5 or 6% on EM stocks. That's pretty good considering what you've had so far, but it's not the kind of returns people might normally associate with a Chinese economic upturn.
So it's priced into the market, you're saying. If we get a better tone of consensus, if they follow JPMorgan to a leveling or even a slight upgrade of GDP growth, as a general statement, how will markets react, and particularly the dollar?
I think if you got a ½ point upgrade to global growth projections, so the consensus is looking for maybe 2.7. If you got something scratching above 3%, I think that could easily be worth another 5% minimum on global equities, because they do price in some upturn in global growth, but it's not a ½ point upgrade. So there is still something to play for if we do get a better performance out of the global economy in H2.
Yeah, this is, John, a chart I did for you. Actually, Hillary Clark did it for me, but we call it the Normand chart. Do you like this?
That is, I can't see it that well.
So this is a correlation. It's basically, the correlation between U.S. stocks and HY credit spreads.
Oh, right. So you should expect spreads to be going down along with stock prices going up. There have been some divergences between those two, and if it's supply related, it's fine. If it's profits related, it's not fine.